This video covers section 2.2 from your textbook on the different types of markets. After watching this video and reading your text, there's a discussion board that I would like you to post an answer to the question that's posed there. And also please be aware that these terms will be covered in a quiz in the class. So there's various types of markets, and a lot of financial instruments exist in more than one of the markets, but it's important to be able to identify the differences. So the first one we have is spot versus futures market. Spot happens on the spot. So if you call your broker and you ask him to purchase 200 shares of Google stock for you, he will do it in the spot market. He will submit a buy order, and the price that you receive will be whatever the price is for today. In contrast, there's a futures market in which you contract today for an event into the future. One of those examples would be like a farmer who raises corn and would like to sell the corn at the end of the growing period, but faces substantial risk. How much rain will he receive during the farming season? So will the crop be eligible for a good price? What's the competition going to be like? Is there going to be a glut of corn or a scarcity of corn? So to eliminate some of those risks, in essence, use a futures contract to pre-sell your product at a determined price. And then at the end of the growing season, you would have the opportunity to close out that contract at a known price. So you know what your profit and or loss is going to be. Obviously, you're shooting for a profit when you set the futures contract. Another example that's given on this particular video is, suppose that you are purchasing something from Japan, from a company that manufactured there. That company would, of course, want to be paid in their own currency, the yen. But US dollars purchasing the yen will vary from day to day, from minute to minute. So you're concerned about the amount of risk you would take on the dollar purchasing less yen and making the product that you bought more expensive. So you lock into a purchase today, and the delivery of the yen to pay for what you're purchasing is going to happen at the same time that you receive the product. The next way that we distinguish is between capital and money markets. This one is extremely simple. It's only time driven. Capital markets are those instruments that are being sold that have a maturity date of a year or more, versus money markets instruments have a maturity of a year or less. So all commercial paper, for instance, must be 270 days or less. So it's all going to exist in the money markets. But long-term bonds, mortgages, of course, common and preferred stock that have no due date are all going to happen in the capital markets. The second or third one is primary versus secondary markets. So primary markets are whenever a company is selling either debts, such as a bond, or equities such as common stock or preferred stock, and they sell those pieces of paper for a promise of future cash flows, and the purchaser gives money for those financial instruments, and that money goes right back to the company. Secondary markets are after a purchaser owns a stock or a bond and then trades it with someone else, and so the money then goes to the person selling from the person who's purchasing, and the company doesn't really have any money, doesn't receive any of that money. So that's a secondary market. Most trades are going to be in the secondary market. The next different type of markets could be distinguished between private and public markets. Private markets are where you negotiate between two different companies or two different entities to place whatever financial security it is. And a lot of debt is placed through private markets. It's not open to the public. Public markets are where we do most of our trading. The New York Stock Exchange, the NASDAQ, the American Stock Exchange. The public can bid on different financial instruments, whether it's a treasury bill or 100 shares of Dell computer stock. And one final note is markets aren't mutually exclusive. So a lot of instruments would exist in several different markets. We talked about the futures trade of corn. Well, that's also going to be on a public market, that the price is going to be set based on supply and demand, just as most things will be in the marketplace. It's also going to probably be less than a year, so it's going to be a money market. So just because an instrument is labeled in one market doesn't mean it doesn't also exist in another market. all common stock is going to be in the capital market. Again, no due date, so it's going to be more than a year. It's going to generally be sold on the spot, so it's generally going to be in a spot market. And finally, most of it's traded publicly. So, all right, now that you've completed this short video, you should go to the discussion board and answer the question, and also be prepared for the quiz.